Hello and welcome to Weekend Investing Daily Bytes. Today we're shooting episode 170 on 27th of January. The markets were following pretty bad cues from the US markets overnight, where the Fed has become very hawkish, looking into the year 2022 and predicting 4 or more interest hikes and going after inflation. In all these scenarios, flows to emerging markets can get hit, and of course, inflation and interest rates hikes are in general not good for the stock markets. So let's see what happened in the markets today. So markets, Nifty opened almost 300 points lower, stayed there for some time, but some of the sectors were very strong. So PSU banks, while it opened lower, but within the first hour itself, it made up for the day's loss and went up 5% higher to end the day at 5.1%. And overall, Bank Nifty was also able to recover back a lot of lost ground from yesterday and close in the green. And private banks were a bit softer compared to PSU banks, but also in the green. Auto stocks were doing quite well. Maruti, Tata Motors, they were very, very stable and did not fall with the market. So all this shows you, the relative strength of sectors in the market. So going forward, PSU banks, autos, these may be the stronger stocks for, with the very short term at least. And as we are seeing that IT is taking a huge beating, primarily on the back of falling NASDAQ and the sentiment around IT stocks. IT, pharma, real estate has taken a beating. In the last week, almost 8% down both on real estate and on IT. So some of these relatively not so strong sectors as of now had to take most of the brunt of today's fall. Nifty also recovered quite a bit, almost ended at near minus 1%, but it had started pretty bad at near 2+%. In terms of the broader indices, Nifty Next 50 took a huge beating at minus 1.7%. And the broader indices like CNX 200, CNX 500 were also down about 1%, along with mid and small cap index. The pure small cap index was down less at minus 0.46%. So that is also a good sign that the larger part of the small cap universe did not fall along with the market and is showing relative strength there. In terms of weekend investing, small cases, we had a bad day, ranging from minus 2.6% to minus 0.3%. MI25 was an aberration with some stocks hitting upper circuits, and it closed at plus 1.71%. So coming to the topic of the day, the rest is Nifty versus rest of the world since pandemic. So we are just taking stock of where we are in terms of versus the rest of the markets. And this is a chart that I had also tweeted today. So today's episode is just about, how we should see things with perspective, and we should also, in this kind of investing, keep a longer term view as to our, the runway of our holding. Because if you see this, now this blue line on top is the NASDAQ 100, which has performed the best since the pandemic started. So we've taken, mid-Feb as, the start of the pandemic and compared the movement of all these global indices since then. So we have seen that, the NASDAQ 100 has done the best at plus 47% since then, roughly. And Nifty has done plus 42%. So Nifty has done almost as well as NASDAQ 100. And has done really well compared to a lot of other global indices, given that Nifty fell almost the most. If you see this black line, Nifty had almost fallen the most amongst all these indices, yet it is one of the best performing indices. So, thank God for that. And essentially, this is also telling you the relative strength of our market versus others, at least so far. I don't know what happens next, but it does seem like, we are performing better and retaining our advances better than other markets. Then this mustard line is the S&P 500. This also fell dramatically during that March 2020 fall and has recovered about 29% and having fallen 10-12% in the last month or so. Then the European markets have been more flatter. Again, they did fall the most during the pandemic and have recovered to plus 15, plus 12%, etc. from the pre-pandemic levels. And very surprisingly are the Chinese markets, the Hong Kong market and the Shanghai index, where on a general basis you can say that it seemed that the pandemic did not hurt those economies as much, but there may have been other issues, China going after the larger conglomerates and so on and so forth, and these two markets are actually lower at -5 and -14% from the pre-pandemic levels. So the idea of showing this relative strength is that we should not lose hope in our markets. Our markets are doing well. Yes, some gains have been given up from the top. There will be churn. There will be stocks which will not go back to their highs. There will be stocks which will re-emerge from these corrections, and as long as you have your strategy in place, or if you are following some strategy, there should not be any need to worry in the short term, because this is not a short term game, it's a long term game. You need to come in for 3 to 5 years at least and see a cycle through. Those who have come in, let's say in the first half of 2020, even now for them, some profits may have been given up, but they would still be sitting on a lot of profits. Yes, those who have come in from 2021 onwards, here, and especially from August onwards, that is where most of the profits have been given up. But if you are coming in gradually and you're bringing in your capital in a SIP formation over 1, 2, 3, 4 years, I don't think there is so much to worry about. And essentially, I want you to also go through several of the daily bytes that we have done, and I'll just reference them to you. Let me just see what all. So this is episode number 148 we have, that where we are discussing why the fall in the markets is nothing new. This has happened several times before. Markets conquer back their prior gains, sometimes quickly, sometimes in a few years. But given that if you keep a longer runway, there is no issue on that. Then again, a lot of questions about whether we will go into a tailspin sort of a crash or not. You can watch this episode 76 on this. I'll give you the link in the description below. Another episode at 113, whether you should worry about investing. I've shown you here in that if you see the performance over a longer period, you will see that as you bring in your capital gradually, it will even out and give you a nice returns over a period of time. Episode 33, how have weekend investing done in the past falls. There you can see how the strategies go into cash, the ones that they do, and those that don't go into cash also go into relatively stronger stocks in a fall. So you need not worry about the fall. The market will have a fall. That is the nature of the market. Market cannot keep going up. We have been going up for since mid of 2020, and it's been a year and a half of just going up. And market doesn't go up one way. I mean, it will go up, it will come down, it will go up, it will come down. So we need to embrace both the rise and the falls of the market, and make sure that we make use of the falls in our towards our goals. Again, another episode 104, long-term investing needs no timing. Even if you're not timing the market, even if you came in at the very top of 1st January 2008 in the previous cycle, or maybe at the top at 1st January 2018 in this recent one, or even on pre-pandemic levels, or at the October highs that we've recently seen, we can showcase and demonstrate to you that it does not matter about the timing if you are coming in for long-term investing. Another episode you should see is that should you be afraid to allocate to equities? A lot of people don't allocate to equities once the market starts to fall, but this is the time when you have to consolidate and allocate to equities. As more and more opportunities will arise when the market falls, you will see that these opportunities where the market is critically at a juncture where there's not enough money most people have to deploy, and there are other people who are having hardly any equity exposure. This is the best time at that point to deploy capital, where the rest of the market is sort of over owned and nobody has enough capital to deploy, and that is the primary reason why market falls, because there are no inflows happening at that point. And so those opportunities are best utilized. So you must watch this episode 57 on that. And then there's another episode where avoiding drawdowns is key to success, and hence how each strategy of weekend investing is sort of geared towards trying to avoid those drawdowns over a longer period of time. And in your own strategies also you can do that. Another episode is episode 34, is how to overcome this fear of investing. A lot of people are having this, first time investors who've never seen a drawdown are very fearful of investing or continuing their SIPs, so on and so forth. Yes, it is challenging, it is daunting at the first instance at least, but even for seasoned players, losing money is not a pleasant experience. But one must always remember that this is the only way where you will enjoy the fruits on the other side once you are invested here on that one. Another episode 38, so you can just go through this library. I've created a library of these 8 videos, short videos, and just go through it, and you will find that this what we are witnessing right now, which may be a beginning of a larger fall, or it just may be a small correction in this larger rise that we have seen. Either way, one should not try to time it. That is the crux of the experience that at least I have seen in the last 25-27 years in the market. Trying to time the market, especially by individual investors, has gone really bad for many investors, and from that experience one should definitely learn something. So this is just a short message that I had today. Thank you so much for watching, and I wish you all the best, and see you in another video. Bye.